for about 40 to 45 minutes, and the last 15 to 30 minutes, I plan to take questions. So that's the agenda for today's discussion. My internet is a little patchy, so if you, Neha specifically, if you see my voice going away, just WhatsApp me and I will try and do something with my internet. So on that note, I'm going to start. The first question, like I said, is why is personal finance important to you? And beside the introduction what Aditi gave, it's a very good introduction she gave in terms of why it's important, but it's also important because as you will realize that money compounds, and your 20s, some of you might be in your late teens, early 20s, that saving money becomes much more than earning money. You might be earning a lot, but how much you save and how well you save becomes very, very important. There's something called the fire syndrome. A lot of you will have it. It's one of the big trends that's coming up in the next decade. A lot of you will want to pursue your own passion. It could be writing, speaking, own business, bakery, photography. Some of you might want to start up on your own. So the more you have in your bank, the better you will sleep at night. The fire syndrome is nothing but financial independence so that you can retire early. So a lot of people, and this trend is catching up in Mumbai, retire in their early 40s. They've made enough money. So the more money you have, the shittier job you don't have to do. But like I said, despite irrespective of which institute you go to, the best in India, IIMs, or the best B schools in the world, everybody has questions on this. And finally, everyone makes the same set of mistakes, and we should avoid these mistakes. The session is extremely critical, needless to say, or else all of you would not have been attending on a Sunday evening. I'm going to go to my next question, and this was in terms of what are the instruments that are available. And there are two slides. Actually, slide number one, I look at debt and equity. And second slide, I will look at gold, insurance, real estate, and a bit of crypto. And these are the various asset classes. What I will do is give you a short commentary on each instrument. I'm going to read the table going from left to right. What is the historical return profile? What is the risk that is involved for a certain amount of return? And what I believe is the relevance for you. So I'm going to start with debt. Debt basically means you give a loan. Person A gives a loan to person B. Person B, as a result, because they're getting a loan, adds an interest and gives it back to person A. It's as simple as that. So there are three types of debt which I'm going to cover, and I'm again reading the table from left to right. First is what we call risk-free debt. That means the earning is largely assured. There is very little risk of default. So the one you're more familiar with will be fixed deposits, HDFC Bank, SBI. If you put an FD fixed deposit, you typically get about 5.5 to 6.5% pre-tax. There's something called Provident Fund when all of you will join work in a year or a couple of years, and a certain amount of your basic, typically 12% of your basic and 12% the company puts in, is put in a PF. This is an excellent instrument because this is backed by the government. You get a return about 8.5% guaranteed, and there is no tax implication to this. So 8.5% post-tax is a phenomenal debt instrument. Now the PF is capped at 12% of your salary, and the company puts in another 12. VPF, which is Voluntary Provident Fund, there is no cap. It's the same instrument as the PF, but there is no cap. Theoretically, you can put 100% of your basic salary in this. So it's again 8.5%, backed by the government of India. You don't need to pay tax. So PF and VPF, excellent instruments from a risk-free perspective. There's something called PPF, Public Provident Fund, you would have heard about. You can typically invest $1.5 lakh every year. It's a function. You need to go to, say, State Bank of India, open an account, and once I think you're 18, you can save 1.5 lakhs per year. There's a lock-in of 15 years. After 15 years, in a way, you can liquidate the account. Gives about 7.1%, backed by the government of India again. NPS is a national pension scheme. It's a retirement saving instrument in terms of you can contribute, whether it's typically 50,000 a year to save tax. You can contribute, you can choose largely in debt instruments. There are some equity instruments. It's meant to tap into it after your retirement, fairly backed by the government of India. Like FDs are with banks, there are similar FDs with the post office, which is also called Kisan Vikas, other schemes where you typically get between, say, 6.5 to 7.5%, but they're fully taxable. So if you go in the highest slab of 30%, you'll have to pay 30% tax on 6.5 to 7.5%, which means you'll only make about 5%. There are bonds, which is given by the Reserve Bank of India. Reserve Bank of India is India's central bank. Typically, these bonds have lock-ins about 5 to 7 years. They pay about 7 to 7.5%, but fully taxable. But RBI, because it is RBI, it's backed by the government of India, and and there is no risk of default. So these are all the debt instruments that are available, which give you a fairly guaranteed return with no risk of default. Historically, ranging between say 5 to 6.5%, and some of the other instruments between 7.5 to 8.5%. Like I said, the risk is very, very low because it's backed by the government of India, and it's highly, highly relevant for you, especially instruments like PF with an 8.5%, instruments like BPF again with an 8.5%, PPF with a 7.1%. It is the best possible instrument you can have right now. Now I'm moving to the second line, which is quality debt. Quality debt means the return is slightly higher, but there is a slight chance that there's going to be a risk of default, meaning you lend the other money a person and he might not be able to pay it back. Now, quality is the risk of default is very, very low, but you get a significantly higher return. So there are two basic asset classes. One is corporate AAA bonds. These are basically mutual funds. A mutual fund like say HDFC AAA bond, and AAA means a company which is asking you for money has the best ratings. It's typically companies like TCS, Infosys, RIL, the best possible rating. That's why it's called AAA. And there's a mutual fund that invests in bonds of these companies. That's called corporate AAA bonds. And the second big asset class is PSU banks. PSU banks meaning State Bank of India, public sector banks. And the reason they are reliable is because invariably with PSU banks, there's a backing by the government of India. So these two asset classes are very good. They typically give a bit between 6 to 7.5%. The big advantage over risk-free debt is that irrespective of which income slab you fall in, you don't pay 30%. So in case of risk-free debt, if you go in the highest slab, you'll pay 30% tax. Here you don't. Here you pay something called around 10%, something called 20% minus indexation, but you roughly pay about 10%. And the risk of default is very low, although there have been a few instances with IFL, DHES, THCL, but generally risk is very, very low, highly relevant for an audience like you. The third is which is called risky debt, meaning they can potentially give you higher returns, but they also have higher chance of defaulting, meaning you can lose your principal. So there's something called credit risk bond. This is I've read in the newspaper a few months back. Franklin Templeton had to shut down a few of its funds because credit risk is nothing but a company which is quality of paper is not very good. So this is AAA. These credit risks might be single A, B minus, but they because it's not so good, they will give you a higher return, say 9%, 10%, 11%. But because their quality of paper is not so good, there is a chance it will default and you will lose your principal. There's something called dynamic bond funds, slightly technical, but basically these are mutual funds where the fund manager takes a punt in terms of the way the interest rate is going to move and how the bond prices will move. Returns have been highly variable. So because you would have heard of Franklin Templeton, the returns were -5. Some cases you lost the principal. It can also go to 8-9%. Very high risk. Strongly advise you stay away from it. It's your hard-earned money. The only thing in life you will learn is never lose your money. So these are the three debt instruments which are largely available. Now I'm going to move to the equity instruments. Equity instruments for some of you is you can buy a share of one company. So you can buy a share of HUL, Hindustan Unilever, HDFC, TCS. Those are called shares. Now, a mutual fund with respect to equities is that a mutual fund might invest in 20 such companies, 100 such companies to diversify. So those are called equity mutual funds. So I'll start with the mutual funds first. And what you will see is the mutual funds can be divided into first is large capitalization funds, meaning these are companies which are very big. On the BSC, they are very, very big in terms of the amount of money that is available. So really big companies like Reliance, HDFC, Bajaj Financial Services, these are all large cap. Now, there are mutual funds that invest in these large cap funds. Typically, you will see that these funds give you the return which is in line with the nominal GDP of the country. So the numbers which you read in the paper that India's GDP is 5%, 4% before COVID, those are real GDP. Now you add an inflation amount to it, and inflation is about 4%, plus real GDP is about 4%, so that's about 8%. So nominal GDP is real GDP plus inflation. And these funds typically give you in that range. So if you see the last 8-10 years, they would have given you between 7 to 8% in line with India's nominal GDP. Over a period of time, there's very limited risk in terms of that. So if you want to get into the equity markets or the mutual funds, this is a very, very good asset class that is available. The second and potentially the best asset class that is available over the last 10 years is the international stock markets, especially the American stock markets. When I do this session, a lot of people ask me that how do you invest in the American stock market? So there are three mutual funds, there are three stock exchanges